Days like this don't come along often, but what do we do as traders and investors as markets crash around the world, over 6% down from the high to the low on the Nasdaq, and the most traded zone on the S&P 500 being finally reached? Well, as it turns out, there are a lot of things to go into, including the bonds market's absolute freak out at the event, and obviously how bad these tariffs really are across the board. In today's video, we break down stocks, commodities, and cryptos to find out what we need to do right now. And more importantly, we talk about the reinversion of the yield curve. Yes, that's right. Everything's happening. Are we about to head into a recession? Let's take a look right now together. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, there is a lot to discuss. The latest macro, the data, and the key levels, and of course, the charts do not look like this. While markets were going a little bit green into the end and the close of the session, by the time we saw the tariff announcement, things went very different. And it was unfortunately a sweeping tariff across the board of over 10% when you really look down into the numbers. Now, why does this matter? Well, of course, it is a universal tariff. And in the previous video, we talked about how this would probably be seen as bearish. During the session, though, there was plenty of information coming out that it was going to just be reciprocal or strategic, and markets like that, actually bringing quite a few calls into the markets throughout the session. Now, there are some interesting things when you look at these announcements. Of course, you've got to take it with looking at all of the information. The big thing here is when you see this official announcement, tariffs charged to the USA, it says including currency manipulation and trade barriers. Now, there are all sorts of little inklings each way in terms of, who's exempt. Some things are actually exempt in here, some things aren't. And there's a lot to dive into that I'm sure we'll see over the next couple of days. But upon initial look at this chart, some things were interesting. Number one, these manipulation and currency barriers mean that some of these numbers are just, frankly, not exactly what they are. On top of that, we also know that some of these tariffs are not exactly what they are either. And of course, this means that we have to break it down. The other thing that I noted was that Canada and Mexico and Russia were not on these reciprocal tariffs. And you may say, well, Tom, it's because Russia has sanctions on it. Well, I think that Iran also has sanctions on it. Again, you can correct me if I'm wrong in the chat. And it has 10%. You also note that, of course, Canada and Mexico don't have them. And that is probably because Canada and Mexico already have tariffs on them. And of course, there are hopefully negotiations going on there to fix it up. So guys, let's get into actually what this means, because the results may surprise you in terms of the overall tariffs that, according to some market pundits, are looking pretty wild when you look at the overall percentage. Now, what does all of this mean? Well, we do have some breaking news here coming in. And as we can see, this, according to Daily Chart Book and Jason Furman, has been basically that there are quite a lot of tariffs. And these particular numbers are starting to look a little bit dangerous. Prior to the 2nd of April's announcement, it was expected that we've had about an effective 10% tariff, 11% tariff. But supposedly, according to this now, the estimated overall weighted average of tariffs across the board in terms of all trade has actually now gone into the 29% category. Now, of course, we'll update this as we get more information over the next couple of days, but you can kind of get an idea of why the market's freaking out about this. And in many ways, it was the worst case. Again, we thought universal tariffs, very bad. Of course, if it was just reciprocal or you would say like strategically put tariffs, that may not have been seen as bad by the market. That's probably what they were pricing in. Now, the problem with the session was that we were told, and of course, the information was spreading like wildfire, that it was going to be just kind of some kind of reciprocal tariff or some kind of like strategic tariffs put across the board. Of course, that wasn't how the market ended up being. And what this meant was that we actually saw rallies throughout the session across the board. Now, most importantly to all of this, we have to be paying attention to a couple of key things. Stock allocation versus sentiment across the board. Now, recently we've been talking about bearish sentiment, and of course that everyone was so bearish across the board. And that's not untrue. That's exactly what we've been seeing. Look at these reports. But of course, allocation generally goes with that. Now, over this particular period, we are going to see, I would think, this thing drop like rock. especially over the next 24 hours. Now, why is this important? Well, because what we hadn't seen was everyone was scared, everyone was worried, but people were greedy. They were not actually selling off their stocks. They were saying they were and they weren't. And we did see this in some of the data. So, of course, we'll try to track this over the next couple of weeks. Make sure to subscribe for it and find out what exactly is going on here. Because until allocation actually goes down, we can't be sure that we're actually seeing a truly fearful market. And that's going to be important. Now, notably, something we brought up earlier in the year, and obviously Buffett's looking like a bit of a genius right now, was the fact that Berkshire was selling their stocks at a rate that we have not seen before. Now, they've been selling their stocks upwards of 25% plus in cash now of their overall asset prices. And this is one of the most important things because when you think about it, it was Mark Zuckerberg, some big Tesla hodlers, obviously Jamie Dimon from JP Morgan, and Berkshire, some of the high profile names that have been selling into this drop so far. Now, is that a worry? Well, of course it is. And, Buffett tends to be early and he's been selling now for well over a year. But we did see, and we are seeing some worrying signs that are starting to appear in the markets. And we'll talk about that soon. Could we still see a rally? Absolutely we could, and we'll go into that. But let's just break down some of the problems. First up, of course, we mentioned this in our previous video, which is that we lost the quarter. So basically March ended bad, the year started poorly, and whenever we lose quarters after streaks like this, there's a 5-quarter streak, that tends to be okay for the next quarter. So we see a lot of ripping and selling off, which makes sense a lot to the stats. Even with the crazy announcements that we've just seen, the next 2-3 months could be absolutely whipsawy all over the place. Remember, when markets sell off at the speed and aggression that they have, even though it's speeding up right now, you'll notice that often you do still get relief rallies. And of course, we did see a small relief rally. We haven't seen one of those really fierce ones yet. But the first quarter can be kind of green, kind of okay. Second, third, 1 year, not so good. And this comes into, of course, the structure that we're going to be looking at after those rate cuts. There are some other bad signs as well. The NOPE index, of course, here below 20, one that tends to not be great when it comes to returns on stock markets. Obviously, we're looking for this to turn back up and show us that the bottom is in. Have we got it? No. Will we get it soon? Time will tell. And of course, we'll be updating if we do get that. Now, let's look at the stats. 14% down is kind of the market period here, where 71% of cases over the last 24 big sell-offs have usually found buyers. And you may say, well, this time is different. Well, generally speaking, it's a pretty important point. Now, at the time of this recording, we're probably down around 11 to 12 from the high on the S&P 500. So we're sitting around here. And obviously, we're coming into significant levels. Most traded zone, which is getting a little bounce right now, and that all-important 5,400 zone. Now, to hit a 14% down, we're going to get to 5,290. So, of course, there are several levels that are getting closer to this current price that need to be paid attention to. Now, what could take the market back up in the sea of turmoil, which is these tariffs and what, again, the unknown. The problem is the market hates unknowns. So it's going to be seeing what is the EU going to do? What are the UK going to do? What is China going to do? What is Taiwan going to do? All these countries that now could potentially go back and say, well, we're going to do this. These are the problems. But one of the good signs, if you are somebody looking for the positives in the markets, is, of course, in terms of the mega cap stocks, they are now the cheapest they've been relative to the S&P 500 in around 10-ish or so years. Now, this is mostly on the current earnings statistics, and it's an interesting one nonetheless. Does that mean it's really cheap? Well, not really. I mean, of course, they're not really that cheap, but statistically, they're getting down there in those oversold signals. Now, we did mention that Jason Gopfert found that the rally that we saw only 2 days ago was likely to be bad. And this is the stat that we got from that, which of course was that we went down pretty hard, rallied back up, came back to the most traded zone on the smallest time frame, which we'll go through again with our TA in just a few moments. And then we have since sold off from that period. Now, does that mean it's all over? Well, the next couple of months can be a bit flaky and up and down, but obviously the overall year stat was still pretty good. With this one, I would just say it was a warning sign to not necessarily love the rally that much. And that's why in our last video we talked about it's too early to call, mostly because of bonds, realistically, that we'll look at. It was too early to call that we'd actually found the low. I don't mind the 5,500, 5,550 level. We've mentioned it many times. We're actually still trading right around that, even after all of these, very, very crazy kind of things that are coming through. But we do need to remember the market, the bears are in control. And you've seen that over that initial shock that just happened just a few hours ago. Now, some of the important levels to be looking at will be communication services, technology, and semiconductor charts. They will need to recover for us to actually say a lows in. And as we saw when we have these kind of big years before, 23, 24, 20% plus years, very, very strong years, you do tend to go into, of course, periods where the market can be up, down, and all around. Now, of course, the tariffs don't help, but regardless, you can see that generally speaking, there are going to be some issues. The other issue is, of course, are we actually going to see a strong April? In some points here from Warren Pies, whenever we've had those really strong years, there's often been a lot of taxation stuff going on, and that can create some outflows. So is April up in the air? Well, of course it is, and it's ultimately going to come back to price and more dark pool activity. Now, what we'll be looking for over the next 24 hours and the next 48 hours with the Fed's announcement, remember, it's going to be jobs numbers Friday. Jerome Powell is going to come out, and if he wants to back the Fed put into this market, he's going to do it then. You would have to think now, is he going to say, okay, we're going to support the market with QE? Is that going to be potentially an announcement that could just come out of nowhere? These are the things the market's going to be looking for. And it's made Jerome's job, a little bit harder. He's going to have to almost say that the Fed is going to put the market, if they want to keep these levels held, specifically 5,400, 5,475. Now, why is this so important? Well, it all comes back to this chart here. And it may look a little bit small, but basically this is all about what happens when we get a recessionary market structure versus a non-recessionary market structure. And at the time of this recording, things are looking towards the worst side. So we're basically at around this point here, and we either continue to drab down, that is, continue to create bad structure moving forward, lose 5,400, etc., or we start to find buyers over the next 1 to 2 weeks. Why is this so important? Because this is the average structure of a recession versus a dip buying opportunity. And of course, a lot of it is going to come back to whether we get a Fed put in, or we see some form of negotiation from the Trump-led government. Now, let's have a look at ADP payroll monthly changes. You guys can see here some interesting numbers coming out in terms of how strong is the overall US market. We'll be noticing this, and of course, we'll give you an update as we move forward on this one very, very soon. In terms of things like CTA estimates, you might be saying, Tom, what about the CTAs? Are they still meaning to buy? These are the latest updates on the CTA estimates. And yeah, that is an interesting one. Goldman CTA models as sellers of global equities over the next week and month. So this is global equities looking at overall sells. Uptake in the US technically still bullish. So again, some interesting stuff here. We've got global equity sells. We have technically US equity buys when it comes to the CTA tape. Wayne Whaley's data still technically stands. Of course, there are 4 outliers to the bullish numbers, but when you have a good January, technically April does work out. Will it do it again this year? Again, it's a stat. We'll be looking for price action. So let's talk about the dark pools that have been put in so far. Obviously, we saw a lot of dark pools near the lows at around that 5,550 on the S&P. Now, at the time of this recording, we are probably at about 5,500, even though the markets just got absolutely mauled. Of course, they were up about 200 points before they dropped off. So funnily enough, you might say, well, these dark pools, these guys are morons. What are they doing over here? Well, actually, they're not really down very much at all. Remember, good price is important, and price holding is also very important. So these dark pools are still around the money, and obviously the Q ones are slightly underneath now, unless they took them out. What we'll be looking for, though, are new big ones, particularly the next 24 hours after, of course, the market actually opens after this news, because remember, we're all in futures right now and after hours trade. And then Jerome Powell's speech. What happens as of the weekly close? What an important week, guys. What an important closure this is going to be. I cannot stress it enough. It's very rare that you see prices like this with news like this, with things that can go like this. We could snap our fingers and get rid of a lot of these problems. It is absolutely wild where we're at in terms of the markets from that perspective. And of course, price action is going to lead this movement out, and we have to leave our emotions on the side. There's no doubt, though, that currently, if that is true, about 29% effective tariff rates. Wow. And we'll update soon on that. Now, what about one-day inflows? Of course, is a little bit delayed, but crypto is holding okay through the session. Obviously fell after the tariff news as well. We'll look at that soon. So let's just put this in perspective. 5670 on the close. This is the S&P 500. After the close, we hit into 5475. And of course, that is, let's just quickly measure this for a second here so you get a bit of an idea. That is a 3.5% fall. So it's a swing of the low. Now, if you are absolutely wild, and I know a few of you guys are a little bit wild out there, you may have had that 54.75 level that we've had on the chart and said, bye, 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 bye. And so far, I guess you'd be up about 25, 30 points. But yeah, we absolutely tanked into these levels. Now, these were the previous option high-low levels. You can ignore the option levels. This was an announcement after hours. They obviously hadn't priced in as much range. I actually got the updated ones. They're so wrong, town. So, just ignore the options. These aren't the new update ones, but just ignore the options levels for the next 24 hours. It's no point in looking at the expected ranges. They'll be completely off with the volatility here. But we even saw the futures market close, obviously, for a second. Then, of course, it opens back up. Look at the gaps. I mean, it was true fear. True fear came into this market as people tried to digest what was going on with these tariffs and what it really meant. It's so difficult to break it down and obviously, really understand what are the ramifications, long-term, short-term, 3 months time, like all of these types of things are going to slowly be priced into the market. So don't try to do it yourself. It's going to be very difficult to do that. Follow the price action, follow the flow, guys. Remember, we do still have a lot of transactions that have been placed in these kind of low levels here. So really the market is still pretty close to those 5,400 or 5,386 on the low. This is, of course, the temporary bull zone for now to see whether the bulls can really regain it. But let's have a look at the options market. And again, this is going to be kind of stuffed because what you'll notice is things were changing through the session. In fact, we were seeing a lot of bull buying. I mean, no wonder the markets wanted to go down. Look at this, 5,700 on the 3rd of April expirations. We were seeing 57s, 5730s, 5750s. All these calls were appearing out of nowhere as people were getting a little bit bullish into the announcement itself. And then, of course, bang, it goes away. Look how many calls there were. Out of nowhere, these calls came. And the markets love to make a good bit of money. So, of course, they pushed it right back down. We still have huge amounts of puts on the OPEX. That is the 3rd expiration of the month. And that means that basically we still have what we call an effective put wall chucked in the system. But if markets do start to freak out in the actual real session and we see continuous sell-off, don't be surprised to get underneath 5,400 relatively fast because it creates what we call a cascade effect, or waterfall effect, which is basically just a whole bunch of hedging coming in across the board. For now, you can see 5,700 is certainly the top end, and I'm sure a lot of you would be happy if it got back up there. And in terms of the bottom end, we're talking probably around 5,475, 5,386, whatever it was we had before on the charts as being the temporary lows for now. Now, NVIDIA, same kind of thing, traded up to a little bit, went down, ended up at 110. After hours trade ended up at 105. That's exactly where the puts have been. So, no real surprises there. And Tesla was up pretty big on the session, hit the 280 call wall. So if you took your profit there, well done to you. Great call wall, take profit. And then after hours, of course, down 6% or whatever it was. So, straight back down. So much vol in these markets. Up, down, up, down, up, down, and all around. All right, let's go to the big stuff here. The bonds market first off. I wouldn't be surprised on the next open for this thing to spike up with some fear. The VIX is obviously going to spike as well. Basically, the bonds market has been saying, you know what, we probably haven't hit the lows yet. We are looking for this to turn around. We want the bonds market to basically get rid of fear as price action rallies up. It was one of the main reasons we used over the last 24 hours to say way too early to tell. And if you go here, you can see yields on the big spreads are going down. We've also got things like uninversion of yield curve and reinversions. So have a look at this. We've got this reinversion of the 3-month. That is the fast one, of course, 3-month yield versus 10-year. And look, the last time we saw these bloody reinversions were back in the 70s. And if you pause the video here, what do you know about the 70s, guys? Put it in the comments. Let's see if you know your history. And if you responded stagflation, then yeah, you would know. So, could we be going for a stagflation environment? Now, if you have been watching the channel for a while and you've been buying gold and you've been buying silver and you've been kind of looking at alternative assets a little bit more than the markets, then you're probably not too worried about stagflation, as gold is pretty much the best for that, and metals. But yeah, it's a very interesting time. Uninversion, then reinversion of the short yields. Interesting. We'll see. But it is that kind of time that it happened last period. So that was the 60s, the 70s, that kind of period, and some in the 80s. Now let's move over to home builders. Home builders obviously look pretty good. I mean, it was rallying a little bit during the session. That'll be down after the tariffs. Of course, we'll figure out what's going on there as we get more action. And the VIX will probably spike out of the gates and then drop. So, again, certain markets, the thing with these is it's not that it was unexpected. We knew it was coming. It's just that probably a universal tariff was not what the market wanted to see. So it's going to have to figure out exactly how is this playing out. And the dollar as well tanked off the announcement, as you can see, selling off that 20 and coming back down to this support level. So yeah, a lot of overreactions, a lot of big moves around the markets. These are the ones that you can make the only thing you can really do is look for correlations of markets. So because we've got a dollar moving to a support, we've got the S&P at the most traded zone of the previous rallies. We have, of course, other markets kind of starting to hit some key supports, but not really what I would call a correlation across the board. Something like gold, it rallied again, very, very strong. Totally overbought, by the way, but the market's up and you do not want to go against it. And silver did okay. It didn't really have a great session. It went down and then up. And that's because silver is a mixture of a currency and a mixture of obviously a useful metal that is used in of course, build outs and infrastructure. So I guess silver is like a pseudo, and at the moment it's still holding the series of higher highs and higher lows across the board. China market didn't really move too much. You can see here the Hang Seng basically just dropped back to these support zones. We'll watch that soon. And Tesla went from 280 all the way down after hours, about 6%, dropped the whole session and back down to, you guessed it, the put levels, the 250 put levels. So XLK, let's have a look at these market sectors. Things were recovering, but not enough, of course. Looks all right off the bid. And at the moment, we've dropped underneath that price. So the problem is that we need to regain some form of high. So we actually, at the moment, have just basically gone up, hit this kind of resistance here in tech, sold off, come up to nothing in particular, mostly just the most traded zone, sold off. We're about here at the time of the recording. If we rally above there, great first signal for day traders. Secondary, go through 220, excellent signals. Of course, that would be where the swing trader buy would be more likely than not in. If we have a look at semiconductors, let's just quickly look at semis. Semis, of course, recovered a little bit. They will drop. Could they be at 200 by the open? That would be how much percentage off? That would be about 6. It's possible if the market continues to stay down. At the time of this recording, probably the most heavily hit aftermarket hours kind of area has been something like the German 40, which is obviously the DAX, in terms of just gap down as soon as the market opened. But again, the S&P lost more. I mean, let's have a look at the close here. You can see it's down 2.56. The S&P, the NASDAQ losing 6% at one point there. Let's now have a look at the NASDAQ itself. Again, just to reiterate that 6%. So we can go from high to the low period, 6.12 switch. Don't see that often. That actually would almost hit, if that was in real hours, that would actually hit a, and actually it'll be interesting to see if we get this, one of those 15-minute blocks. The word stops me here, but you can put it in the chat. But basically, what that basically means is we've got circuit breaker. So we hit a circuit breaker. We haven't seen a circuit breaker in years now. So we have not seen one for ages. And that in itself is pretty wild. But yeah, big switch, negative candle. Of course, now we have a high that we can mark out. And this is going to be a high along with this 20,400 that every bull will be looking at in the future. These are huge zones now to be checking out. Now, in terms of whether this has actually hit support, not really. I would say the first support actually is around 18,350. I think this is reacting to the most important chart, which is generally going to be the S&P 500. Let's have a look at the Russell. The Russell didn't like it either. Dropped these two little rejection wicks, went higher, hit into the res, sold off. Again, a negative candle, but what can we do? We can mark out that high. and say, well, this is a significant level, should we breach it in the future? Because we know there were quite a lot of buys here. So of course, the thing is that a lot of those are going to get wiped by stop losses. We're going to see a ton of liquidations coming through over the next 24 hours once the market's open. Hopefully that's not you guys. And then we'll find out how this really wants to trade. What we're looking for is options, and we're looking for dark pool liquidity. We will be very much on top of this the next 24, 48 hours. It's imperative that we see what happens from the Fed. Because I would think, and it's going to be an interesting one, that the Fed might be forced into some type of action here of effectively being accommodative for the market. All right, that did not go black screen then, but we'll just move over here to Bitcoin. Bitcoin, of course, moving up to 88. Was having a pretty good session. Now, look at this. From that breach, you hit resistance, 5% up. Not bad, actually. And if you took the trade off at the resistance before the announcement, you'd be happy. If you didn't, well, you're back to square one. So basically, it's still holding an interesting zone. And Bitcoin was actually the best. It was one of the best sectors in the markets in terms of actually finding that nice buy pressure. In terms of Ethereum or other cryptos, they all just fell back to their lows. And of course, huge swings of, very high percentages, but not unlike crypto to do this. So what's the down low really? Well, it really comes back to just basically saying, okay, what do we know about these tariffs? We have to let the market, the real market, that is the volume, actually now digest it. We need to get weekly closes. We need to see if there are any unusual trades coming in. And ultimately, we need to see whether this is a superior overreaction. Remember, markets 71% of the time do not sell off over 14%. Maybe that is actually a trigger point that actually says, okay, we're on the recessionary path. Because after an inversion of yield curve, we are between usually 6 to 18 months away from something serious happening in the markets. And as you can do your numbers and dates, you would know that we're between 6 and 8 months at this stage. So what that really is telling us is that we need to see a bull buy for the structure not to turn into the recessionary path. What an important time for markets, guys, and certainly well worthwhile paying attention to it. You're really going to have to be on this one. To put things also in perspective, I guess the big thing here is that we do still have Fed Chair Powell, we have ISM PMI on Thursday, and we have non-farm payroll. So these are all the New York Times for that. And just also remember that while everyone's going to be making huge claims out there, oh, the market fell this much, it did for sure. And it is a scary number. But you've got to remember the S&P 500 only just undercut the previous lows that you were at literally at the end of last week. So 54.75, it hit it, went a little bit lower and rallied up. And we're currently trading at 5,500. Well, actually, we've been at this level 3 times now. So, what's going to happen next? Well, we'll find out with the big dark pools. Unfortunately, we don't have much information. And if you are bearish, of course, at the moment, the bears are in control. If you're interested in finding out more about what we do, check us out next. Check out our 7-day flash sale. Thank you so much for watching. And what an interesting next couple of days we're going to have. Guys, it's wild. Stay in tune, and we will see you in the next one. Bye for now.